Hello everyone, this is Marshall Gittler speaking. I'm going to discuss the main issues facing the FX market in the week beginning 30th of October. Well, there is so much going on this week. There are three major central bank meetings, the monthly US non-farm payrolls and the EU inflation figures. Not to mention that, we're likely to get the decision on the next Fed chair, plus an idea of what the House of Representatives version of the U.S. tax bill is going to look like. Now, against that background, I think a lot of the indicators are just going to be noise during the week, although it's likely to be a lot of noise. I think probably the most important item in the long term is who is going to be the next chair of the Federal Reserve System. The head of this organization now doesn't have total power. Here, thinking of them as the head of the FOMC, the Federal Open Market Committee, the FOMC is a committee after all, and the committee members are appointed independently, and they have tenure. Nonetheless, the head of the committee does have a significant power of persuasion and the power to put forward proposals for a vote. And so it is a very powerful position. Now, it seems that the decision is down to two men, Jerome Powell and John Taylor. Jerome Powell, or Jay as he prefers to be known, has been a governor of the Fed for 5 years. Although he's not a PhD economist, he now has considerable experience with both macroeconomic policy and bank regulatory policy. These are the two main tasks of the Fed and the two jobs that the Fed chair is in charge of. Now, Powell has the reputation in the Fed as a consensus builder. On the other hand, Taylor, a professor at Stanford University, is an academic who is famous for creating a policy rule to determine mechanistically the optimal level for a central bank's policy rate. He's been persistently critical of the Fed's monetary policy for years. He's argued that they should be led more by rules like his rather than by their own discretion. He has worked at the U.S. Treasury, but he has no experience at the Fed and no experience with bank regulatory policy. His one big advantage, though, is that he's a big favorite of many Republican politicians who have these crazy ideas about abolishing the Fed and going back onto the gold standard. Now, what are the implications of choosing either one of these fellows? If Taylor gets the job, I think then everyone will immediately assume a more hawkish Fed, even though, of course, the FOMC is, as I said, a committee, and Taylor has just one vote, just like anyone else. The Fed funds futures rate will start to discount, the Fed funds futures will start to discount a faster pace of tightening, and I think the dollar will probably shoot higher. On the other hand, if Powell gets the job, then the markets would probably relax. The reason is that Powell means continuity. There'd be no change in the market's assumptions about rates or the unwinding of the Fed's balance sheet. Now that wouldn't be necessarily be cause for a weaker dollar in itself, but it would probably mean a weaker dollar just because it eliminates the risk, or would no longer be the risk of Taylor getting the job. Now, one possibility that's getting a lot of discussion is that since the vice chair position is vacant too, Trump might appoint one man as Fed chair and the other as vice chair. If Powell and, now, how would that work out? If Powell were chair and Taylor were vice chair, that actually might work quite nicely. Pardon me. Taylor would still get to put forward his views, and as vice chair, these views would get more attention than they do right now. He might even be able to tilt policy somewhat towards a more hawkish stance. And there are several examples of noted academics in the role of vice chair, such as the previous incumbent, Stanley Fischer, who was a professor at MIT. But importantly, Powell would still be running the show. Now, this is important because, as I said, he's a sign of continuity of direction. I think this could cause the dollar to rally modestly because it gets Taylor involved but not in charge. If, on the other hand, Trump tries to make Taylor the chair and Powell vice chair, there are big questions. First off, would Powell even accept being number 2 to a guy he disagrees with, especially after he spent 5 years effectively training for the number 1 spot? Secondly, can Taylor run the Fed when most of the staff disagrees with him? Remember, he's not just the head of the FOMC, he's the head of the whole organization. I don't think this would work so well. I think the dollar might go shooting up initially for the reasons I said it would if Taylor were appointed alone. But I think over the longer term, this solution, like Taylor alone, might just cause confusion and dissent at the Fed and would therefore be negative for U.S. monetary policy and the dollar longer term. Okay, moving on to the rest of the week, let's take these central bank meetings in order that they come. The Bank of Japan kicks things off with its meeting Tuesday morning Japan time. The meeting includes updated forecasts in the quarterly economic outlook report. They're expected to revise up their GDP forecast a bit, but perhaps revise down their inflation forecast. Nonetheless, I fully expect that they'll stick to their belief that an expanding economy will bring rising prices eventually, even though there seems to be no proof of that anymore. The main point of interest here with the Bank of Japan is probably whether they announce any change in their yield curve management system, as there's talk that they might start targeting the 5-year sector instead of the 10-year sector. We could hear something about that in Governor Kuroda's press conference afterwards. In any event, the Bank of Japan days tend not to be particularly volatile ones for the yen recently. As you can see from this graph, all of the Bank of Japan days this year after January have seen below average volatility. That's probably because people wait for the meeting to see what's going to happen, then nothing happens, and then there's no incentive for trading. On Wednesday, it's the turn of the U.S. Federal Open Market Committee, the FOMC. Here too, nobody expects them to make any changes in policy rates. Furthermore, since there's no press conference scheduled for after the meeting, nor any update on the forecast, all the information that we're going to get will be in the statement following the meeting. Everyone will be reading that statement closely for signs that about whether the Fed will raise rates at the next meeting in December. But now looking at the statements of previous meetings this year, there didn't seem to be any obvious clues the month before they raised rates that they were going to take action the next month. I think they may make some further comments about the economy continuing to expand despite the hurricanes, as well as noting that the unemployment rate has fallen further, and this could be a sign that they're happy with the way things are going and on course to hike in December. In any event, though, the market already sees an 87% likelihood of a rate hike in December, so it's hard to imagine this meeting moving the dial any further. I think it could cause the dollar to firm up a bit, though, just out of reflex more than anything. The big question is what the Bank of England's going to do, because here there is a chance that they move rates. In fact, the dollar is convinced that they're going to hike rates. Right now, there's an 88% probability on it, which is about the same as the Fed in December. The big question then, assuming that they do hike, is whether they signal it's the beginning of a hiking cycle or just one and done, as they say. That's likely to be the key to the market's reaction. As the graph here shows, the change, we've got the overnight index swap graph curve for the 27th of July and then the 27th of October, 3 months later. The change in the OIS curve since July, when no rate hike was expected at all this year, and now is only 25 basis points out to 5 years. The significant thing is that, as you can see from the gray bars here, the change is pretty uniform across the curve. This suggests that the market's now pricing in only one more rate hike than it was then. In other words, the pace of tightening is not expected to be any faster than it was before, just that it begins a bit earlier. So maybe not one and done, more like one and pause. Now, you've got to watch the statement and the press conference afterwards for anything that suggests anything different from that. I think that's what they'll say, though, and that ultimately that may be the cause for some profit taking in sterling. Meanwhile, as I said, there's a flood of important data out during the week. The most important one will be, as usual, Friday's non-farm payrolls and its precursor, Wednesday's ADP report. After the drop of payrolls in September, the market's looking for a massive leap of 310,000 in October, as lots of the people who were thrown out of work temporarily because of the hurricanes go back to work. Even so, that would be an average increase of only 138,000 a month, which would be below trend. The 6-month average in August, before the hurricane-induced plunge, was 150,000 a month, 153,000. Nonetheless, I think this would be acceptable to the market since, of course, it'll take several months for employment in the storm-hit regions to recover fully. On the other hand, there could be some disappointment if growth in average hourly earnings falls back, as expected. This series is also distorted by the hurricanes because more lower-paid workers were laid off because of the hurricanes than higher-paid workers. That boosted the rate of increase in wages artificially. So it's natural that the rate would fall back a bit as many of these lower-paid people go back to work. Now, there's a lot of other important data coming out this week. The German inflation data comes out on Monday, and the EU-wide inflation and GDP on Tuesday. But since we already know what ECB policy is going to be for the next several months, that probably isn't as important as usual. China and Britain's purchasing managers' indices come out during the week, as does the US ISM index. And Canada's GDP, trade, and employment data come out during the week. But enough is enough. This is already more than anyone wants to listen to. So, what are my conclusions for the week? I think the dollar is likely to strengthen on the assumption that Powell becomes Fed chair and Taylor vice chair, plus an FOMC decision leaning towards tightening in December. I think the yen is likely to weaken a bit on just a general risk-on mood and probably a higher Tokyo stock market. The euro is likely to weaken on the recent dovish ECB decision and the worsening Spain crisis. And GBP, the sterling, is a difficult call because it depends so much on the Bank of England decision, which, as I say, is really a hard call too. I think that sterling is likely to weaken if the Bank of England comes out as one-end pause, as I expect. Well, this is Marshall Gittler bringing you the outlook for the week beginning October 30th. Thank you for listening, and good luck with your trading.